financial markets responded very positively to the Fed's announcement overnight, sending the Dow Jones Industrial Average and S&P 500 indices up 1.55% and 1.63% respectively, to reach new 2012 highs. Gold also enjoyed an impressive rally and breached the 1780 level briefly. Nonetheless, bonds have weakened, with the 30-year yield breaching 3% while 10-year yield closed flat at 1.756%. The responses in bonds were interpreted as the Fed showed tolerance of higher inflation by its open-ended purchase of mortgage-backed securities. In the currency markets, dollar was broadly sold off, with the euro, US dollar breaking 1.3, while sterling and commodity currencies were also sharply higher. Yen's gain against the dollar was relatively limited so far as supported by yield, and yen crosses were also sharply higher thanks to risk appetite. Chairman Ben Bernanke announced a number of policy changes to stimulate the U.S. economy. First, he initiated purchases of agency mortgage-backed securities, starting tomorrow at a total of $23 billion through the end of the month, and then at a rate of $40 billion per month for an open-ended period. Buying will continue until the employment market has shown desirable improvement. This program will be different from the previous one, which had defined a fixed period and amount. The Fed maintained the option to alter the size, pace and composition of its asset purchases as appropriate, suggesting the purchase amounts might be adjusted depending on economic conditions. Meanwhile, Operation Twist will continue through the year-end. The interest rate guidance was adjusted as policymakers decided to keep the Fed funds rate at 0 to 0.25%, at least through mid-2015, from a previous forecast of late 2014. More importantly, the Fed stated that it expects that a highly accommodative stance of monetary policy will remain appropriate for a considerable length of time after the economic recovery strengthens. This is a stronger language than previously used and indicates the Fed's commitment to leave interest rates at low levels even if the outlook begins to improve. On the data front, Japan industrial production dropped 1% month-on-month in July. Eurozone CPI will be the main feature in the European session. From the US, CPI is expected to climb back to 1.6% year-on-year in August, with core CPI dropping slightly to 2% year-on-year. Retail sales are expected to show 0.7% growth in August, with ex-auto sales up 0.6%. Industrial production is expected to show 0.1% growth in August, while University of Michigan sentiment is expected to drop slightly to 74 in September.